Excuse me. Right, video 3 for the day. This is the Euro US dollar we looked at this morning. That took at 7 o'clock, and as you can see, it didn't reverse and then continue back up again. It just had a steady reversal. Now we're well into the American session now, and it looks like this could possibly start to push to the north side again and go up and test that oh, it's not on this chart now, that daily high that was just up there. So it might be a reversal to the long side, but we'd have to break through this support here, close through that, and we could possibly see a push to the long side. And then I'd want to see the cup forming here on the H1, much the same as this I'm talking about here. You know what, hopefully you can understand what I mean by a cup. It's where the CCI bars stop falling and then actually turn up. So the first one that turns up after it's closed, that's when you have a go at your analysis. So when this one closes up here, if it does, and I'd probably like to see it close above that the high of that candle there, and then possibly we'll have another little reversal to the south side, and then it might cruise on up to the long side. But you know, we're going to have a little bit of trouble here where this support becomes resistance area is here as well. So it's not clear. It's getting, I don't like trading the American session particularly. Excuse me, but it's something to watch, and I might make a video about it a little later. Anyway, what I wanted to show you was this scenario here. I want to show the importance, or what I consider the sensibleness, if you want, of not having indicators on your charts. This was a template set up by someone else I found online, and I was playing around with it for a while, but quite frankly I found it just confused matters. This is an M1 chart, and I'm going to show you a little trade I took as well, because it's important to understand, in my opinion, and I've spent thousands upon thousands, tens of thousands of hours watching charts, as you know, from previous videos, that you don't need all these flashy little arrows and things. It's just laziness, really. You just need to do something like I showed you on the previous videos. Open your charts with nothing on them in the morning, and then just do your bar by bar analysis, moving down from the monthly. You don't always have to use the monthly, because obviously it doesn't change day to day, but at least from the weekly, daily, right down to the trading time frame, which is really your 5 minute. If you're just scalping, or you know, it's not scalping, it's trend trading. If you're just taking a few pips first thing in the morning, doing it day in, day out, every day, just wait for the trades to come to you. So let's get rid of all this rubbish on the chart and show you how nice it looks without indicators on there. There you are, clean chart. Excuse me for this damn cold that's getting me down. Right, so I've come back in after the London Open. This is roughly where the London Open is. Sorry about this. That's roughly where the London Open is there, and as you can see, we're looking for longs as always. This would have had to have made, especially on a 1 minute chart, this would have to have made a very, very strong trend to the downside. This would need to be red, remember, or the price at least to be below it, to even consider taking a short. This should be below the zero line as well, something like that. This was a downtrend forming, but it just ran out of steam there. So the little trade just now, I'll show you, is basically based on the cup forming here. Now, I wasn't about at this stage. You'll probably say, right, well, if you're looking at a reversal against these, and you're looking for the oversold broke through the 100 level on here, this is the difference here. You wouldn't have considered a trade there necessarily, and you can see it ran out of steam quite quickly because this hadn't been oversold. Meanwhile, you would look for a trade potentially there, although that was part of a downtrend, so it won't be really part of an uptrend. When I say part of a downtrend, I'm talking about this scenario here: high, low, lower, high, lower, low, lower, high, lower, low. This was just a swing to test this resistance here, support rather here, to see whether it could break through it. So it hadn't clearly broken through it in my opinion, but regardless, you understand what I'm trying to say. This is this would be a potentially valid signal, although it's quite risky at that level. I always prefer to be looking like the cup, as opposed to, this isn't a cup because it's broken through the zero. It's not, it mustn't have broken through the zero line and gone red. That's one of the things I try to avoid. There's plenty of trades out there all day long if you're prepared to wait for them. So getting back to this little instance here, what I also like to do is you break the trigger candle and bar. These are all perfectly good valid candles and bars. I want to see the trigger candle broken by a couple of pips, at least one clear pip. And also I don't want to be entering after a tail has formed. I'll show you what I mean by that, or a wick on the candle. So it didn't break through, we didn't get a valid clear break of this little green candle's high here. It just poked its little nose through there, but not enough to take the trade. So that was a failure there. But what's also interesting, I'll point out here, so here's where I took the trade, because this was a strong engulfing candle. It engulfed 1, 2, 3, 4, 5 previous candles. In other words, it's the open of the candle was below all the lows, and the high of the candle, or the close of the candle, closed through all these candles. That's a very bullish move in the long direction for a green engulfing candle, a bullish engulfing candle, which is a B-U-E-B. That's what that stands for, bullish engulfing. Here we've got our cup forming to the long side. You've got the rising candle, the rising bar, that bar's closed, that's good. We've also got the bar closed through the zero line. That's the zero line there, of course, if you're not familiar with these. So it's closed through. So what you want is, in a perfect world, you want a green above zero, of course that will be green then, and something that's a very bullish candle. This wasn't a bullish candle really, by no means, with the wick there, and then it continued to down. This could have come down and taken you out for 5 or 6 pips or whatever at that stage, and then we would have started all over again. And that's what screen time does for you. So that's it. Entered there, aiming to get out before the first sign of problems up here, which you could have put at the high of that candle there, which would have been a good 13 or so pips, less the spread, 36 to 39, that's 13, so good. I only want 7 or 8 pips, that's my rule in life. Just load it up high, you know, go £10 a pip or £100 a pip or whatever you feel comfortable with, as long as your account size can take it. I'll talk about that later. And then get out, and tomorrow's another day. This area here is some sort of supply and demand area, because it's pushed through there and created the wick, and it's pushed through there. So I was happy to take it just to that level. As you can see, we're off again. There was probably a signal there. Yeah, it's closed through the 100, and we've that would have been the signal bar there, because it's the cups formed again, notice, and although we didn't turn yellow, this is something I've just been using recently, the indicator on here, and it's different for different pairs. If you've got a low volatility pair, say for example, well, this is usually quite low volatile, then I increase the decrease rather the trigger, so the 100 is good enough. If you've got a high volatility pair, something like pound yen or Aussie euro, then this I would tend to push further, maybe even down to, it triggers at 120 on this one, I think, I can't remember, in fact I can see, yeah, it triggers at 120, that's the level that it turns yellow. You can change that to, look, I'll change it for you, show you, 150, and that will change there, watch it closely, there you go. you've lost one of the yellow, and that's just what I do. So there's no hard and fast rule. You just have to adjust them to the currency pair you're trading, and also the trading conditions. At the moment, everything's quite volatile because of what happened with the Aussie dollar today. I should imagine the market makers are really having a ball. So anyway, this was meant to start out as a short-term video, but it ended up being a slightly long one. Sorry if I've bored you, but at the end of the day, you know, you don't have to watch it. Thank you for watching anyway. Bye.